Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is stockdarts, and as we do every Wednesday, we're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish with that, we'll take a quick look at the US dollar, see how it's doing, see how it's affecting gold, silver, and possibly oil, and then from there we'll move on to chart requests. Anyone that's in here, if you feel like looking at a chart, you're not sure, you have a question on it, feel free to put it into the chat, and I'll go ahead and try to give you the best read I can on it. For those of you that are watching the recording of this, you can always ask me on Twitter. You can see here on the screen. You can follow me at Twitter at stockdarts. You can follow me on YouTube, stockdarts, or you can visit me at patreon.com/stockdarts, where I post weekly blog content. But if you're watching this and you didn't get a chance to ask me a question live, well, you can always ask me on Twitter, or you could just email me at stockdarts@gmail, or you could visit us on our Discord, anywhere you want, and I'd be more than happy to help you out and give you my take on whatever chart you're looking at. Other than that, let's go ahead and get started. What we're going to do first is look at the ETF SPY. It's been an interesting week. The market has actually been pretty strong, as we could see over the last 3 days. While we have printed 3 red candles, we did gap significantly higher on, well, not significantly, but we gapped pretty high on Monday. Those are new all-time highs, and that's always pretty nice. We had a nice breakout on Friday with volume to push past our recent highs, and overall the markets are starting to really look like they want to go ahead and shift gears and explore higher. Now, of course, there's always the one caveat, which is the small caps, which we'll get to in a little bit. But overall, the markets are looking pretty healthy, and they look like they want to go ahead and try to rally. And if you just look at the S&P 500 in a vacuum, things are looking pretty good for a full-fledged breakout and a strong move into the holiday season as we approach Thanksgiving in a couple of weeks, and then, of course, the Christmas season, which tend to be usually pretty benign as far as the price action is concerned, and more often than not, we tend to rally into the holidays, even if it is on lighter volume. Now, that wasn't the case last year, and that's not always the case, which is why you can't just sort of blindly go ahead and trade the holidays and say, well, we rally every year. But more often than not, we do rally, and the market has been setting up like it wants to go ahead and try to rally into the close of the year. And so far, it looks like all systems are go, except for, as I said before, the small caps, which we'll get to after we cover the other 3 major ETFs. But looking at the S&P 500, things are looking pretty good. You can see over the last couple of weeks, we were slowly building our way back up towards all-time highs, and then we were able to really kind of peek through them and then push through on Friday. And then, again, as I said earlier, so far this week, we've just spent 3 days consolidating. You can see the volume has declined steadily as we've sort of just sat there and drifted and towards our highs. And I don't think that there's anything negative I could point out here as far as just the chart of SPY is concerned. Everything is looking good, and it's looking like we're just consolidating and setting up a bull flag or just a run-of-the-mill consolidation, ready to go ahead and retest our breakout and then start to probe higher. You can see the moving averages have been slowly climbing. We've got this nice curl up underneath price action, and it's ready to just break out. Now, the only thing I could really say negative as far as looking at the S&P 500, if you're looking to be bullish, is risk reward is not really that great right now. But it is a good time to go ahead and be bullish, and I think that's the thing that we always want to look at when we do our Wednesday market reviews and we look at the market. We're not always looking to trade the S&P 500 or the Qs or IWM. What we're trying to do is gauge what kind of market we're in and what kind of price action is going to be more prevalent in the environment. And I think at the moment what we can kind of conclude from this is that we are in a bullish environment. While trade on SPY right now would not really be recommended, there are charts that are offering better risk reward and better setups than what we're seeing on the S&P 500 or the NASDAQ or even IWM, and that's where we want to be looking. Is we want to look at charts that are giving us better risk reward setups, but we know that we're in an environment that's looking to go higher and looking to try to explore new all-time highs. Over the last 4 or 5 months, and really throughout the year, I've been kind of focusing on range-bound strategies and taking advantage of a market that's been kind of trading sideways. And if we could get a full breakout here, then I'm going to go ahead and shift gears a little bit and start looking at trading breakouts and looking at momentum trades to the upside. And I think that means a couple of different things. For one, it means starting to trail stops a little bit more and starting to try to get more, trying to take advantage of longer moves to the upside. Two, it means taking advantage of breaks through highs rather than just always playing support. Especially over the last 3 or 4 months, I've been focusing a lot more on premium selling, and I've been focusing a lot more on buying at support and buying at value. And that's because we've been in a market that's been chopping sideways. And we're not 100% out of the woods yet, so I'm still kind of holding judgment until I see what happens with IWM over the course of the next week or so. But if we can get a full-fledged breakout in the market, then I think it's time to transition towards more bullish strategies that take advantage of a market that has more momentum to the upside. And again, that means playing bull flags, playing breaks through consolidation ranges, and making sure that we try to get as much as we can out of trades by trailing stops higher, rather than trying to take advantage of near-term ceilings and closing trades a little bit early or selling premium against them. And again, not fully there yet, but it's something that I'm going to start considering a shift towards if we continue to see this behavior over the course of the next week or so. All right, so what are the key levels we want to look at on the S&P 500 as far as figuring out where we're going to move from here and what support levels we can count on, or even just tell us that we're in a bullish environment, right? So we now have a new short-term area that we want to keep our eye on, and that is the recent highs from back in July and August and even through September, which is around just above 300 on the S&P 500, around 302. We've broken through that, and I think at this point we don't want to see a consolidation fall back below that level. If we fall back another 5-6 points, that's still okay, and I think that's still bullish. What we don't want to see is a move back below that, and below particularly about 301 to 300. Because at that point we're definitely clearly behind or below this level, and we're starting to fall back below our moving averages, and I think that's going to be a problem. And that would be really the idea, or the level that you want to look at in the short term if you want to really figure out, well, am I going to be bullish here? Am I going to start looking at breakout trades? Then this is one of the key levels, is making sure that the S&P 500 can hold above that price point. And if it can, then I think things are flipping more to the bullish side. Now again, I think the more important thing for us to consider is still going to be IWM and what it's going to do, and I think that's going to tell us whether we're ready for a full-fledged breakout or whether we're going to just sort of build slowly higher. But as far as the S&P 500 is concerned, I think as long as we stay above 302 to 301, then I think things are bullish, even if they're moderately bullish, and we just continue to slowly build upon our recent ranges. And if we fall back below that, then I think that's when we start to worry a little bit. But even then, if we do fall back, I think as long as we stay above 293 to 292, things are still looking pretty good. Now, if we look at the weekly chart and get a better idea of what exactly we're seeing in the longer term, you can see that we're starting to lift off, and we're starting to really push through and possibly start exploring newer highs. And I've mentioned this before, and I'm going to mention it again. I've been kind of looking at this for the last 2 or 3 months, and I think the best example we have of a situation similar to that is what we saw back in 2016, right before the election, when we were just sort of consolidating and holding above our previous range, which we also spent a good portion of time. You can see we've spent almost the same exact time now. You go ahead and move this rectangle. It's very similar. What we did back in 2014 to about 2016 to what we've done recently, and I think overall, it's the same sort of behavior. We're just sort of starting to push through a broad base of consolidation and trying to confirm that the price action is ready to move past it. Now, this time around, it was a little bit sloppier as far as trying to break through it. You can see there was a lot of going back and forth through that ceiling, but in the end, what we could take away from it is that at least for the moment, we're finally past that level. And if we sort of mirror the price action that happened the last time that we had this sort of move, well, you can see we had a run for almost a straight year, straight to new highs. And I think that that's the kind of potential move that we can be looking at in the next 4 or 5 months, if we can continue to build on this. And of course, I think the key for that is going to be IWM. But if we don't get a strong move out of IWM, I still think that this is a pretty bullish move. And at the very least, as long as we hold, of course, over 302, I think that we can at the very least continue to sort of stair step and slowly build our way higher until we can get the small caps to participate. So I think overall we're on the cusp of what could be a really nice bullish move. I don't think that if you just pay attention to social media, you just pay attention to the CNBC, I don't think that's really the picture they're giving you, but that's what it looks like to me. And as someone that just trades price action and really just gauges how the market is behaving, I think that we are setting up for a pretty strong rally, and I think it's just going to come down to whether we can get the small caps to participate or not. At this point, we had excuse me, we had FOMC last week, and they lowered rates yet again, and we've gone through most of an earnings season with no real mines in place to blow up the market, and really the only news that we have that could possibly affect us right now is if we have some lingering doubts with the China trade wars, but I think for the most part that's not really an issue at the moment, and so the market looks like it's going to just trade off technicals, and if that's going to be the case, well, the technicals are all pretty sound, and nothing here at all points to a market that's topping out or a market that needs to come back down. So I think overall things are pretty strong and pretty solid, and if you're worried, as I've said the last month or so, we have price levels that you can use as warning signals, right? So if you're worried about highs and you don't think that the market's ready to push through that, well, your first warning signal is 302, which we went over. Your next warning signal is 293, which we went over. And if we fall back below that, well, then we still have the 200-period moving average supporting price, and we have this nice zone around the 280s that also supported price. So we've got a lot of different potential support zones, and as we start to lose those, you can start to adjust your stance in the market, right? So if you're kind of nervous and you don't really think that we're ready to push through, well, watch 302. If that happens, then you can start to raise a little bit of cash, or you can start to close out a couple of trades. If we fall below 293, then you can start to look at being more cautious and looking at different types of trades, possibly putting on some hedge trades, and then vice versa. Same thing as it keeps going down and down. Vice versa, as long as we stay above 302, you can be a little bit more aggressive as far as trading to the long side, because you know the market is looking right now to probe higher. And so that's one of the key things that we do when we do these Wednesday market reviews, is we're trying to gauge what kind of environment we're in, and also understanding what are our contingencies if the market does not behave in the way we expect. And so what we do is we set up these different price points that might affect the market, and if we go through them, then we understand that we should have contingencies in place to protect ourselves if that happens. But I think for the moment, really, the key is 302. I don't think we're going to fall below that from here to next Wednesday. And as long as we stay above it, I think that things are pretty bullish, and we should be looking to trade to the long side, and probably kind of aggressively. Now, if we look at the NASDAQ, we'll see a chart that's almost a mirror image of the S&P 500. Same thing, we broke out nicely on Friday. We've got 3 days of consolidation, volume declining, so it's kind of a bull flag. Nothing, people are going to look at this and say, well, the market's topping out. We've got 3 red candles. And I would say for the moment, the jury's out on whether this is just a bull flag or whether this is some distribution or supply that we're running into. But even if it is supply, we've got some room to the downside before we get back to our previous highs. And I think just like the S&P 500, as long as we stay above, I'd say about 195, we should be looking to trade to the long side, and we should be looking to be aggressive, because we have a market that is really starting to push through the range that it's been kind of stuck in for about two years now, and even really starting to push well past the range that we've been kind of caught up in the last 3 or 4 months throughout the summer. If you look at June, July, August, September, and where the ceiling for the NASDAQ has been, we're starting to push past that. It's been 194 to 195, and we had a nice move through that at the end of October. And now as we start to move into November, you can see we're slowly starting to climb higher. And I think, again, there's nothing bearish here. Everything here is looking strong, and there's nothing at all that I could point out to this, with the exception of the 3 red candles, that says that this is a chart that's ready to go down. And even these 3 red candles, I mean, you're going to have red candles everywhere. It's just the nature of price action. You're going to have buying days and you're going to have selling days. And overall, when you look at the declining volume and you look at the tight range, I would say at the moment this is more indicative of consolidation rather than of some sort of major pocket of supply or distribution that's going to come in. So we are at a big fat round number, which is 200 on the NASDAQ, and these numbers tend to have some validity to them. Keep in mind that whenever we're looking at price action, you're looking at attitudes of humans and human behavior, and people in general are going to gravitate towards bigger numbers and round numbers. It's just the way we go ahead and establish value of equities, is we tend to anchor on big round numbers. All right, so there's really not much else that I can add to the S&P 500 that's very different from the NASDAQ. Again, you can see the moving averages starting to curl up. You can see anytime you see these moving averages start to spread out like this, like you see the 20 climbing and the 50 starting to branch out, that's usually indicative of a nice trend to the upside as well. You can see anytime they really start to spread out, that tends to mean that you're going to have some strong movement to the upside. So that's another sign, again, showing that we're looking like we want to start climbing higher. And I think, again, we need to be aggressive right now, and I think we need to make sure that we pay attention to the long side and that we don't get too cautious or fearful of the market. If the market ends up topping out here and if we end up rolling back over, like I said on the S&P 500, we have warning signals. We know what levels are going to be available here for us to decide whether we need to change our stance and whether we need to be more proactive about protecting our capital. And again, the first level is 195. I imagine more likely than not, the first level is actually going to be the 20-period moving average as it comes up to meet price. But for now, we can look at 195 as kind of a key area. If we lose 195, I think even if we come all the way back down to 189, I think things are still pretty bullish. But it would definitely be more indicative of a market that needs to spend more time trying to establish that it's pushing past that 2-year ceiling. So if we look at a weekly chart, we can see that if we do fall back below 195 and come down to 189, while in the short term it definitely is indicative of a chart that needs more time to trade sideways, you can see in the long term it's still doing good things. It's still basically trying to hold above the previous range and just continuing to establish this sort of beachhead as it tries to go ahead and move forward and leave this recent range of consolidation behind. And again, we've spent a couple of years here trading between about 152 to about 189 to 190, and we're really starting to forge through that. And again, it's very similar to what we did in 2015, 2016, 2017, where we traded sideways for a while. Eventually, we started to kind of trade above that range, and once we were able to establish that as a new range of value, the market really started to climb higher. And so again, it looks very similar, and at the moment, I'm inclined to believe that we're in the same sort of environment. We're ready to start pushing higher again. Now, if we look at the Dow Jones also very similar, slightly weaker if you look at it from a relative perspective. We just barely eked over recent highs. Now that was one kind of weird wick off of some earnings on some Dow Jones components, but overall, also at new all-time highs. We also had a nice breakout on Friday, and we have 3 days of consolidation on lower volume. So really, it's sort of the same thing. You've got the moving averages curling up to meet price, and I think at the moment, the one issue with the Dow Jones is that the first sort of point of contention is pretty close. So again, showing a little bit of relative weakness compared to the S&P 500 and the NASDAQ. So if you're looking for different areas of the market to trade, maybe you want to look at the NASDAQ a little bit more, or some S&P 500 components rather than the Dow components. The Dow components are struggling, and again, the Dow doesn't have that many components, so it's kind of hard to really make these broad, sweeping statements on what exactly is going on with the Dow, because it could be held back by 2 or 3 different companies rather than the market's going to take a lot more before it's held down by a few companies. And so that could be the issue here. But overall, the Dow Jones is still doing well and is still mimicking what we see in the S&P 500 and the NASDAQ. And we have, again, our first warning signal, 273, and then our next warning signal is 265. But I would say for the moment, I'm more inclined to pay attention to the levels I pointed out on the S&P 500 and the NASDAQ, or IWM, and at the moment I'm not that concerned with the Dow. I think typically with the Dow, I'll pay more attention to it when it's a leading index. That's not really the case right now. I think at the moment it's kind of trailing behind the markets, and as long as it continues to do that, I think we just watch it and pay attention to see if we start to see any divergence. But at the moment, I don't see really anything to concern me with the Dow Jones, and everything I've said about the S&P 500 and the Nasdaq, it's going to apply to the Dow. So just keep an eye on that. Keep an eye on these levels that we're looking at. But more than anything, we want to see if there's any kind of divergence with the Dow, whether it starts to lead higher or whether it starts to pull back earlier. And I think if that happens, then we'll have to just sort of analyze it and see what's going on. But for now, it's doing what it's supposed to, which is just mimicking the other two indexes. And then finally, we have the small caps. And the small caps, I think, is the one. It's the one concern I really have. And really, it's because of today's candle. I don't like where we stand right now. For those of you that are regular viewers, and I'm not sure which of you guys are in here. Oh, it looks like Ray's here. Hi, Ray. For those of you that are regular viewers, you'll know that this is a really important line in the sand for me as far as really getting behind a full-fledged breakout in the markets. I think I think the small caps need to break through this 158 to 160 level. I think that's critical. I think this is an important gauge on how much risk traders are willing to accept and how greedy the environment is at the moment. And I think with what we're seeing today, it shows that traders are still kind of scared and they're still not fully behind taking risks. And for that, the reason for that, of course, is we're starting to fall back below what I consider a pretty strong ceiling on the market as far as IWM is concerned in 2019. You can see as far as this year is concerned, we've tried to break through a 1, 2, 3, 4, 5, 6, at least 6 or 7 times already, depending on how you want to classify some of these attempts, right? Whether you want to consider this one try, whether you consider this a try, but overall you can see every time we come up to 158, we end up falling short and pulling back, and each one of these pullbacks has coincided with a broader pullback in the overall markets. So the small caps have definitely been kind of the anchor holding back the price action and holding us from really pushing through the market and making our way higher. And I think that's the case again. As you can see, we're starting to struggle again. Now, the other three indices all look great, but if the small caps can't break through this level, then I think it's going to hold back the other indices, and they're going to start trading sideways and probably try to stair-step higher rather than ramp up and really rally strongly like we saw back in 2017. And I think that's kind of the key here, is if we can get the small caps to participate and start to explore this vacuum here. If you go to the weekly chart, you'll see what I'm talking about. There's all this empty price action between about 158 and then our all-time highs, which are around 173. But anything in the 170 area, a move all the way up to there could happen quickly if we could finally break through this level. And I think if that happens, that would coincide with a very strong move in the markets that is likely going to be 4, 5, 6 month rally where we just continuously climb without any major pullbacks. And that's what I'm hoping for. But until we see IWM break that, I think we're more likely than not going to continue doing what we've done over the last 3 or 4 months, which is just slowly build higher. Again, I'm going to go just to look at the S&P 500 again. And if you look at it, especially if you look at it on a weekly chart, you can see that we've been making highs, right, for the year. So it's not like we haven't been bullish. We've been slowly climbing higher, but you'll notice it's been, especially over the last 5, 6 months, we've just been kind of slowly making our way higher, then pulling back, trying to come up higher, and we're just slowly stair-stepping higher. And if IWM doesn't break past 160, then we're probably going to see this sort of same behavior, and maybe even a move all the way back down and start to come back and retest 295, and really just sort of spend more time waiting for IWM to catch up to price before the market tries to push past that. So I don't think it's the end of the world if IWM can't break past 160 again, but I do think if it can, then I think it's a good signal of a really strong market incoming. So this is one of the areas that I really want to watch. is to see what happens here and to see if we could break through it. Now, I will point this out. Um, it's not the end of the world that we're struggling today. If you take a look at the price action over the last month or so, it's been straight up, right? And more often than not, when you come up to a major level of resistance, and let's face it, this is a major level of resistance for 2019. As you can see, it's struggled several times to go through that. So it doesn't necessarily make sense to just kind of climb right into there and then climb right through it without stopping and pausing. So I don't think it's the end of the world yet that we're starting to struggle here. But the key is how we respond to this. Are we going to respond to this 158 level the same way we have every time this year, where we pull back sharply and start to come back and test lows? Or are we going to kind of stop here, maybe trade sideways for a few days, and then start trying to push back above it, which really we have not done other than this one time that we had this big reversal in May. And I think that's really the key is, today's price action I don't like at all, but it's more important what we see out of tomorrow and Friday as far as how IWM handles this price range and what happens next. Ray, you say you have IWM November 15, 157, 159 call spread on right now. Okay, all right. So you say average credit of 118, but if you have a bullish call spread, then that would be a debit. So 157 to 115. All right. So you got a bullish play, hoping for the breakout. It could happen. We'll see. I'm hoping for it, but so then that's not a bull call spread, Ray. That's a bearish call spread. That would mean that you're looking for IWM to stay below 158 or so. Okay. And again, this is a coin flip right now as to whether IWM can get past 158 or not. Obviously, it's been a major level of resistance, so got no problem with you attempting to for that call. That's actually a good idea. Anytime that if you think a stock is range bound or you think a market is range bound, which for the most part that's what we've done, that's what we've been, especially in IWM, then playing the edges of that resistance is a good idea. So as much as I want this to break out, I think that's a decent play. But we'll see. We'll see whether IW can finally break through it and start to push past it and go past that. Okay. All right. So that's the four major markets. As you can see, the S&P 500, the NASDAQ, and the Dow Jones are all very bullish. And really the one issue is IWM. And if we can get the small caps to kind of fall in line and break through that zone, then that would be good for the overall markets. It would not be good for Ray and his current play, but it would be a bullish move as far as the markets are concerned. However, if the small caps continue to struggle at this level and fall back below it, then I think the important thing right now is how do they respond to this? Do we make another move all the way back down to lows, or do we just hover around this price point for another couple of weeks, and then once we have some consolidation, then attempt to break out again? I think that's kind of the issue. Okay. Yeah, Ray, with IB, a lot of times they call it, it depends on how you set it up as to what they'll call it. And then if you sold it, it's a bull call spread, but because you sold it, you're really taking on the opposite side of that. You know what I mean? So if you structure a play like when you build it, if you build it as a 159 bull call spread, IBM is going to call it that, or sorry, IB is going to call it that. But then if you sell that play, you didn't actually take the bull call spread. You actually took a bearish call spread. I know it's kind of just we're kind of just looking at semantics here, but that's kind of the issue. Is if you call it a bull call spread, my first impression would be that you're looking to play long, but you sold it, so that you kind of turned it into a bearish play. Okay, but I mean, yeah, IBM is going to call it whatever you construct it as. IB, yeah. Or, a lot of almost any company. If you just look at it, you build it as a certain play, it's going to call it that. And then if you sell it, you're taking the opposite end. But yeah. All right, so that's the four major markets. Again, I'm inclined to believe that we are ready to rally, and it just depends on whether IWM participates. I think if it does, I think it sets up the market for a strong move. They don't, then I think that we're still bullish, but it's probably more along the lines of what we've seen for the last couple of months, where we just slowly transition our way out of the ranges that we've been stuck in. Okay. All right. Let's take a quick look at the U.S. dollar. And you can see the dollar has been strong over the last 2 or 3 days. Kind of interesting considering we had, more lower interest rates last week, and you can see last Wednesday's day with the more volatility, and we kind of pulled back. And I think overall, the U.S. dollar is starting to lose traction here, at least as as an aggregate. This chart, this UUP index, is heavily weighted in the euro. And so when you look at the euro, it's going to be an inverse chart because this is a euro chart. But you can see the U.S. So in this particular case, the U.S. dollar down is good for the U.S. dollar. You can see the U.S. dollar has rallied over the last 3 days and is starting to push back against the euro. But the euro has had a very big development here as it finally bottomed out and reversed what has been a pretty consistent downtrend on it. And it's really starting to, I think at this point more than anything, I don't think it's flipped bullish, but I think it's definitely flipped to neutral and is going to be trading sideways as it builds a broader base to eventually try to reverse and start making its way higher. And you can see it's made its way back to what is a temporary level of support. I don't think this is a major level, but this should offer some support. You can see you'd call this a double top if it was at a top, but it's not. It's just kind of trading in a range here. And there's a chance that this is going to be a key level here. And there's just so many price points right now. But if we look at the weekly chart, you can see what the euro has done versus the U.S. dollar. And where it's at right now, what it's trying to accomplish. And I think that the goal right now for the euro is to make its way back up to about 113.8. There's plenty of room to the upside there, but it's still struggling, and it's still trying to break that downtrend. If you really want to look at it in a long-term picture, it hasn't really established itself as breaking that longer-term downtrend. And so there's still work to be done. But I think overall the euro is still holding up okay. And again, some of you might be like, well, why are we watching? What are we looking at the euro? I thought I thought we were watching the markets and looking for stocks here. Well, I think it's important to understand where the U.S. dollar is going because it has impact on different areas of the market. And as you guys know, I like to look at gold and silver, and a lot of times it's affected by what we see out of these currency crosses. Also, I like to trade Forex. I think anyone that has a good background in technical analysis should be able to trade any instrument that has a chart, whether it's Forex charts, whether it's a stock chart, or whether it's even a Bitcoin chart. I think you can trade any of them validly as long as you understand price action, because the price action here, when we're looking at this chart, all these lines are telling us these are representations of human sentiment and human ideas of what value is on a chart. So that's what we're looking for here. Now, if we look at the U.S. Canadian, you'll notice that the U.S. dollar again started to rally and started to bounce after a pretty stiff rejection here at the 133 level. And it kind of came down pretty quickly. So the U.S. dollar has lost ground against the euro and against the Canadian over the last 4 or 5 months, and it's starting to struggle a little bit. Now it is finding some bouncing here, and it's starting to find some support, but it's got a long way to go before it really shifts that market dynamic a little bit and becomes bullish again. I think for the moment, if we start to bounce up into all this resistance, it becomes a possible short, especially as it starts to approach 133. And then finally, if we look at the U.S. versus the yen, this is the only one that's a little bit different because the dollar has been depressed versus the yen for a while, but it is now in the process of finishing a nice inverse head and shoulders and starting to break above that. So I think that this one's setting up for a nice rally and has potential to make its way up, a pretty decent amount for those that are looking to trade a bullish U.S. dollar move. I think that the dollar versus the yen is probably a lot stronger than it has been versus the euro and the Canadian. Now, as we transition to gold and silver, you'll notice that the fact that the U.S. dollar has been strong over the last 2 or 3 days has put a dent on what was looking like a nice breakout on gold and silver. You can see GLD had a nice move here at the end of October and was able to get a nice 3 days of action above its moving averages and looked like it was starting to really want to climb higher. But then with the US dollar finally getting a bounce, it put a lot of pressure back on gold and silver. Now again, remember, gold and silver are priced in dollars, so like anything else, if the US dollar, if you're bought for US dollars, the stronger the US dollar is, the less value you have, and vice versa. And if we look at silver, you'll see a very similar picture. Now, I will point out one thing that's a little bit different here. Some of the miners are actually looking pretty decent, despite the fact that the gold and silver chart doesn't look that great. The miners are looking like they're finding a little bit more of a headway here. If you look at one of the charts that I had recommended a couple of weeks ago, looking at gold trades, you look at TRX and you can see that it's finding good support here at about 77 cents, and with today it's got a nice move, and you can see volatility starting to expand in the range. And if this thing could push through again and get past this 83-cent level, it's got a lot of potential to the upside. Another one that I've been looking at that I had mentioned is KL, which, Ray, that you're here. Ray, you're the one that brought this chart to my attention in the first place. And you can see this massive triangle pattern, and it's starting to break through it. Now, they might have earnings. I want to double check. Gold miners tend to have earnings a little bit later in the earnings season. Yeah, so they have earnings. Well, it's estimated for today. Don't know. Maybe they did have their earnings. I don't know that they had it yet. I didn't see that. But anyway, some of them, the estimates tend to be a little bit off. But they have earnings pretty soon, so that is something to pay attention to. But they are starting to break out and starting to push through that triangle, and it looks pretty good. Now, Ray, you say you bought gold options December 6th, so you went out a little bit further. That's nice. 140 calls on GLD. All right, that's not a bad play. It's a good level of support. What if you bought them? Well, I guess depends on when you bought them, but that's pretty good. I mean, they're kind of at the money right now. They're obviously you need another move. You need at least another $1.50 on this. But I think that's a possible play. I think that's a decent place for it. I'd like to see us get back above the moving averages and push past that. I think that we're at good support here, but it's going to depend on what the US dollar does. The US dollar keeps kind of depressing these. And then you also bought JNUG, 65 call at $7. Wow. All right. Again, I do like the gold miners. I think the gold miners are setting up a little bit better than gold right now. Make sure to be quick with your JNUG. It's looking all right. Again, I'm not going to charge JNUG because really, it's a triple leverage fund, but it's based off of what we see on GDXJ, and what we have here right now is a channel that it's trading in. It's right back at the bottom of the channel, so I think that's a good purchase as far as the level's concerned. I like the candle that I'm seeing today. I think that was a good move. And ideally, it's going to make its way back up to 39.40 to 39.60 on GDXJ, and then of course the corresponding levels on JNUG. For those of you that maybe don't know, JNUG is a triple leveraged. It's a triple leveraged fund. You can see triple X shares, so it's going to be more volatile on its way up. But these tend to decay over time, and the longer you hold them, the worse off that they are, right? They tend to decay quite strongly over time. It's just the way math works, and so the longer you hold these, the more likely the position is going to go against you. So it's almost like you're playing with options. So Ray is kind of doubling up on that by using options on a triple leverage fund, so you're going to get double decay on that because you're going to get the natural options decay and you're going to get the decay um, of the ETF. However, you get a lot of leverage, and if you can time your moves correctly, it'll work for you. But you have to be quick and you have to be very proactive about taking profits. As you can see, it's going to mimic GDXJ, so you're going to have the same. You're going to have the same basic patterns, right? Overall, it's kind of trading in a downward channel, but in the short term, it's trading in an ascending channel, and you can see it more clearly on GDX because this one's not leveraged. But you can see the same pattern, right? We're trading in the intermediate term. We're just kind of trading sideways and kind of in a sort of a descending channel. But in the short term, we're making our way back to the top of that channel. So that's basically your target, Ray, is right here. Oh my, wow, this thing's starting to act up. I don't know what's going on here. Did I double click something? I'm not really sure why my chart's behaving a little bit different now. There we go. Alright, so that's GDXJ. Let's take a quick look at oil. Actually, we'll just go here. Alright, and as we can see on oil, oil has found resistance around 57 to 58, which we kind of looked at last week as a potential level of resistance. It probably needs to come all the way back down to about 54 and continue to sort of ride this trend line up. I think overall it's just stuck in the sideways range, and it's just kind of chopping back and forth in there. And I think oil names are not the area that I'm really focused on in the market right now. I think it's kind of there are better places to look rather than trying to trade oil. I think that oil has basically been really messy this year, and it's really struggled to go back and as it goes back and forth between about 50, 51 and about 60. So like the 50 to 60 range has just been kind of going back and forth. It's kind of in the middle of the range right now, which makes it even harder for you to really decide whether you want to be bullish or bearish. Because there is room for it to climb to 60, but there's also room for it to kind of come back down. And I don't think the risk reward's there, and I don't think that there's enough of a prevailing direction for us to really want to go ahead and look at trading it. All right, so that's oil, gold, and silver. I think the gold miners are offering a decent opportunity here. It's nice to see, Ray. You have a couple good trades there. I like that all three of the trades that you've shown me today have sound reasoning behind them. So it's good to see that coming from you, Ray. And hopefully they work out for you, both the gold and the JNUG and even the IWM play. Even though I personally want IWM to go higher, I think it makes sense to go ahead and play the ceiling of that range until it can definitively break through it. Alright, so we've got about 10-15 minutes. If anyone else that's in here, I see we have a few viewers. If you guys have a chart you'd like to add to the discussion, go ahead and type it in. I'd love to see what you guys are looking at and see if I get a better idea of what's going on here as far as what other people have eyes on. Also, if maybe you're not sure how to type into the stream chat, I know that some of my viewers have had trouble with that in the past. If you look at the top right, there's a little button where you could expand the chat. Maybe you're not even seeing that there's a chat here. So, as far as my personally what I've been doing, over the last couple of weeks, as I said, you guys, I was telling you earlier that I've been looking at range-bound strategies and trying to take advantage of stocks, particularly during earnings, that are trading in a range. We took a nice play on Netflix on my Patreon page, and I went over it last week, but just to kind of reiterate what I've been doing over the last few weeks. We took a play, selling volatility and selling premium here, looking for a bounce on Netflix, and we were able to take advantage and capture this move as Netflix sort of spent some time trading sideways, and then we flipped it to a bullish play, and we're able to catch extra upside on it, and it closed out being a very nice play for us. This week, one of the trades I was looking at was the same sort of idea, looking at capturing some premium on McDonald's and looking at a possible support bounce. Now, I didn't recommend doing this with stock. I thought that this was something we wanted to do, selling premium, because I think overall, if you look at the McDonald's chart, it had what could be looked at as a head and shoulders recently, and this is not the kind of play where I'm looking for a strong bullish move. I just thought that the move to the downside was a little bit overdone, especially with the CEO issue, and so I thought that there was a chance for a reactionary bounce. And at this point, we've gotten pretty much what we wanted out of it with this 3-day bounce, especially using options to just take advantage of the inflated premium on these particularly big down moves. And so those are some of the range-bound ideas that I look at, is looking to take advantage of stocks that are coming into support and having premium that's inflated, whether it's from earnings, whether it's a news event, and you go ahead and you take advantage by either selling put spreads, which is sort of the opposite of what Ray did with IWM, or by taking calendar spreads where you're selling the front week and then you're buying the premium for the following week. So that's some of the kind of stuff that I've been doing on my Patreon page. Now, if the market can really flip to bullish, we'll be looking at just more straight up buying shares and just sort of scaling out as the stock climbs higher. And that's something that we'll be looking at a little bit more carefully. But it's still, a lot of it depends on what IWM does and whether we are fully transitioning to a bullish market. If we do, then that'll be great. If we don't, then there's always plays like this that develop where we get premium sales based off stocks that are stuck in a range. All right, well, that looks like it covers it. So, again, if any of you guys were maybe too shy to type in a chart request and you didn't want to add it here, you can always message me on Twitter, or you can just email me. I'll be more than happy to help you out and give you my thoughts on whatever charts you guys are looking at. That kind of covers it for today. So have a good rest of this week, and we'll meet again next Wednesday.